Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Chief Economist Phil Mackintosh at Nasdaq to discuss some of the trading activity that we witnessed last week and some of the more popularly traded names. But Phil, before we get into that, we still are in the middle of a pandemic and need to monitor what's happening with vaccine progress and, of course, the hotspots within the economy. So let's start with that. What we're seeing in terms of vaccination progress. It looks like we're moving ahead, but perhaps the market thinks not quick enough.
Yeah, I mean, the reality is the data last week was pretty good. We're definitely seeing the new cases in the US come back from the high levels that they reached after Christmas and Thanksgiving. We're seeing the hospitalizations come back as well. So people are getting out of hospital now, which is great news. And we're also seeing those vaccinations per day continue to increase. They're now well over 1 million per day. So on that front, it's good news, although a little bit slower than we expected. And I think one of the problems that we had last week was a lot of the news on the new vaccines. Merck pulled out of one of its tests, and just the production bottlenecks that we're starting to see are global, but are sort of making people reassess whether we really will be back to normal by summer or maybe later this year. And so that's why the market took a little bit of a breather last week.
And we take a look at some of the economic data. It really is two tails of the tape. Some sectors are performing well, but others continue to struggle.
Yeah, and basically what you've got is the goods sector is going great and the services sector is really struggling. And unfortunately, like when you look at the manufacturing data and you look at a lot of the sort of production data that's coming out, we're back above pre-COVID levels. We've got a lot of confidence in the sort of corporate manufacturing space. Because people are able to buy goods. They're doing a lot of house renovations, they're buying cars. But the flip side is we're not going on vacations, we're not sitting in restaurants and eating like we used to. And so the services sector, which is actually much bigger, has been a bigger drag on employment. And you can see that with last week's GDP and unemployment data. The GDP was down, but not really that much if we look at the blue bar on that chart that's blue and orange. But the unemployment is down far more. And that's because the services sector has really been hurt by everybody self-quarantining, working from home, the social distancing, and that's affected employment much more than it's affected production.
And Phil, speaking of last week and even moving into today, when you see increased volatility, you're also seeing heightened trading volumes as well.
Yeah, I mean, the real story last week wasn't the volatility increasing, it was the volumes increasing. We saw a record level of volumes one day last week, 24 billion shares, which is about 20% more than the previous record, which happened in the middle of that coronavirus sell-off. And also a similar number happened back in the credit crisis sell-off. So on relatively low volatility, we saw a really strong trading day, which is very unusual. If you look at the data, typically as volatility goes up, trading goes up, which makes a lot more sense. Right now, we've got relatively low levels of volatility in the market, but a huge explosion in trading.
Right. And one thing I really want to focus on was sort of that crowd trade that we saw last week, certainly a phenomenon and leading into this week's trading action as well. And part of that was focused around heavily shorted stocks. So explain to the audience the role of short selling and how that ultimately led into what we saw called a short squeeze.
Yeah, I mean, there's a lot of evidence in research papers that shows that short selling is actually good for markets. If you look at a classic arbitrage strategy, the way that you keep ETFs tracking their net asset value, that you keep futures and stocks at the exact perfect values, is you've got market makers able to short the expensive side of the trade to buy the cheap side of the trade and pull different assets back together. So shorting in the market as a whole is actually really important for market efficiency and for price discovery. There are some hedge funds and funds that are out there to say, I'm going to find a stock that I think its revenues are falling, its performance is deteriorating, and actually they provide selling pressure to speed that stock's price discounting. And so that's another reason that there's short selling as well. But what's interesting is every time you want to put on a short sale, you actually have to go and borrow the stock from somebody who's long first. And so you then effectively have the stock to deliver to the next person that buys it from you. So when you have a short sale, what you actually do is you have an increase in short selling, obviously, but you actually have an increase in net long owners as well. So if you see a stock that is hypothetically 20% short interest, it's actually 120% long, because every short seller has borrowed stock from somebody who owns it. and then they've traded again with another natural buyer. And so you've got an extra buyer in the system as well. So all of these people talking about, you know, high percentages of short interest, there's actually a lot of buyers on the other side, a lot of natural longs as well.
And we're also seeing options play a part in this trade.
Yeah, so the volumes that spiked last week were somewhat sector or stock specific. There's a lot of highly shorted stocks that have seen a huge increase in activity, and so that's a classic short squeeze. It's not the first time that we've seen short squeezes in the world, but what happens if somebody starts to buy a shorted stock? The person who has borrowed that stock had to post collateral to the person that they borrowed it from, and so that collateral needs to go up at the same rate as the stock price goes up, so that the person that lent it isn't going to lose money on their loan. And so that's kind of like a margin call. And eventually, if you have enough of a rally in stock price, those margin calls can trigger the short sellers to cover, so they don't have to keep making margin. Also, if you're buying the stock itself in options, the options which we saw, some of the huge options activity in some of these shorted names, the options market maker, if you buy a call in the option, the market maker has to go buy the underlying stock as well, because that's how they keep themselves delta hedged. And then as the stock price goes up, the delta changes, which is called gamma. And so they need to re-hedge to their higher delta. And so you end up with a situation potentially where there's natural buyers of the stock, there's short coverers buying, and then there's option hedging buying as well. And that's part of the reason why we've seen some pretty exponential price returns in these shorted stocks last week and huge amounts of volume.
Right. And that's exactly what I want to wrap up with here, because technically stocks can go to zero, but technically they can also go to infinity. So when you see these hundreds or thousands of percent return at some point, regardless of your opinion on the stock, it's going to distort the fundamentals. And that can actually freeze the company's strategy, right? I mean, what if you're in the middle of a deal? What if you're in the middle of, looking at different ways to access the capital markets? That's a concern.
I mean, I think I worry more about the investors that are getting in late, because you're right. These stocks have disconnected from fundamentals. They're really not even a momentum trade anymore. They're up so fast in such a shorter period of time. They're up so much. I worry that once the excitement leaves these names and the last buyer gets in, some reality will return to the market, and there's a chance that a lot of people that have bought in the last couple of days will be left with big losses. Maybe not levered losses, but they're not going to get their money back, and that's going to be bad for market confidence. It's going to be bad for the investors that are involved in these trades too.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.